Welcome. If you're at the joint IMF-IMFS seminar on negative interest rates, if that's where you wanted to end up, then you're at the right place virtually. People are still coming in. It always seems to take a little while for everyone to come in, just technically. So we have about 200 people in the virtual room right now. Welcome to all of you. It's fantastic to have you here. My name is Volker Wieland. I'm the Managing Director of the Institute of Monetary and Financial Stability, which is a very small organization, academic organization here in Frankfurt, which many of you participants know because you have been to other webinars we've organized. And this is a joint event with the huge organization in Washington, D.C. and all over the world, the International Monetary Fund. We're delighted to co-host that. And my task is to welcome you on behalf of both organizations. Also, welcome to our speakers today. In the order of appearance, that's Gaston Gelos from the International Monetary Fund, Silvana Tenrero from the Bank of England and the London School of Economics, and Jörg Kremer from Commerzbank. So it's still good morning in Washington, D.C., good afternoon in London, and almost good evening in Frankfurt. So great to be able to do that. I think most people have come in. So let me just say a few more words on the topic and the presenters, but very briefly. First, I think the topic is a great topic to have, negative interest rates. We don't all like them for different reasons. The question is, do they achieve the objectives? This is particularly about negative rates imposed by the central bank. Directly, so at which either they lend to banks or they allow banks to deposit funds at the central bank. Of course, you know, here in Germany, we have also other negative rates. We have now, you know, banks can borrow from the central bank at -1% if they lend it out under the TLTRO operations. We have negative rates on government yields because of quantitative easing. And so we're particularly interested in this discussion, but the main focus, of course, will be by Gaston on the negative policy rates. And this was a paper by the IMF, which is published today. And Gaston is one of the authors or the lead author. So first, let me say two words about him. I think with Gaston, we met way back when I was still in DC and you just started in DC in '98 after obtaining your PhD from Yale. You studied also in Germany, right, at Bonn. And you had a fantastic career at the IMF. Nowadays, you're Assistant Director and Chief of the Monetary and Macroprudential Policies Division in the Monetary and Capital Markets Department. And previously, you worked on the Global Financial Stability Report, which we've also deeply absorbed. Many of the participants are well aware of it. You've been in all different parts, Western Hemisphere Department, research, European. You've worked on financial liberalization, banking issues. So it'll be great to hear from you. Next up will be Silvana Tenrero. We're delighted to have you. As I said earlier, she's an external member of the Bank of England's Monetary Policy Committee since July 2017. She's also a professor of economics at the London School of Economics and currently serves as president of the European Economic Association. She obtained her PhD from Harvard and started her career at the Federal Reserve Bank in Boston. And there are many other things I could mention. I found it particularly interesting that you also served as external policy member, multi-policy committee member at Mauritius, right? Which is a beautiful place, of course. I think Stefan Gerlach, a friend of mine, also did that at some point. Anyway, thank you. Coming to the third person, Jörg Kremer, it's fantastic to have you also on the board. We basically have the paper from the IMF. We have someone from a central bank deeply involved with these decisions. And we have with you someone from, a major experience in banking. So on the receiver side of these policies, you have obtained your PhD from the Kiel Institute, another place I've also frequented, and we met in many different occasions. And you have been, or you currently are, the chief economist at Commerzbank already since quite a while. You're a well-known person here in the banking, in European banking circles. Before that, you were had different chief economist role. You started out, I think, at what was Merrill Lynch, but you also were chief economist at Invesco and at Bayerische Hypo and Vereinsbank. So this brings me to the end of the presentations. I also want to mention my colleague Michael Binder from Goethe University and IMFS. If my connection breaks down, he will, the seminar will go on, and once you get to the Q&A, he will take over the Q&A. For the participants, be aware all throughout, you can enter questions already in the Q&A tool, and you can vote on other people's questions so they can move up. And once, I think each presentation will be at most 15 minutes. And basically after that, we'll go to the questions. I'll read them and we have people respond to them. So no further delay. Thank you. I'll hand over directly to Gaston.
Well, thank you very much. Let me try to share my screen. All right. Well, thank you very much for the opportunity to be here and to discuss our work. Thank you for the Institute for Monetary and Financial Stability for co-hosting this event with the IMF. It's really a pleasure to be in this company on this panel. So before I start, I need to show you the usual disclaimer that what I'm going to present here is not to be attributed to the IMF, its board or its management. This is joint work with my colleagues Luis Brandão Marquez, Mario Casiraghi, Güneş Kamber, and Roland Meeks at the IMF. So what motivated us to write this paper? Well, starting in 2012, various central banks have pushed key policy rates below zero. And this was unprecedented at the time and raised many questions. The need for additional monetary accommodation has become even more topical with the COVID-19 crisis and as the economies recover. So we wanted to take stock and with the experience with negative interest rates so far, and ask whether these policies had worked and about the extent to which potential side effects had materialized. In doing so, we draw both on insights from the academic literature and from more general country experiences. We focus on aspects that are specific to negative rates. So it's not about low rates more generally, it's about the specific aspects related to negative rates. And the paper was just released. It's available on the IMF website. So what's the background to this? Well, the backdrop to negative rates is the secular decline in real rates of interest since the mid-1980s. And the so-called neutral rate, which is compatible with full employment and price stability, is now close to zero or even negative in many advanced economies. There are various structural factors behind falling real rates: changing demographics as populations are aging, slowing trend productivity growth, and most likely also a shift in demand towards safe assets. And so central banks have been struggling to adapt to this reality because with inflation targets around 2%, low real rates mean that the nominal rates are also very low. So this implies that central banks have very little room to maneuver in positive territory. And so here the upper chart shows you the real average interest rates in advanced economies since the mid-1980s. And the lower chart shows changes in policy rates around business cycle peaks between 1990 and 2019. And these are again averages across advanced economies. And the point is that to show you how the reaction of central banks in advanced economies has changed post-crisis and before, post the global financial crisis and before. The solid black line indicates that before 2009, policy rates were cut on average by between 4 and 5 percentage points when a recession hit. After the global financial crisis, there has been much less policy room. And in response to the COVID-19 shock, the average reduction has been just 0.7 percentage points to date. So this lack of conventional monetary policy space means that central banks have resorted to unconventional monetary policies to maintain price stability. Now, all conventional measures present advantages, but also shortcomings. And given these trade-offs, including negative rates in the mix can be beneficial. It allows central banks to rely less on other tools, mitigating any side effects. In small open economies, negative rates can contribute to ease exchange rate pressures, reducing the need for FX intervention. In addition, a broad policy package allows synergies that can amplify the effectiveness of each measure. For example, in principle, negative rates can reinforce forward guidance as it removes the zero lower bound constraint. It can also, in principle, help steepen the yield curve, potentially helping banks in conducting maturity transformation. Now, at the time of the introduction of negative rates, there were serious questions about the effectiveness and the potential consequences of the policy. There were various fears, right? This was new and unprecedented. Would there be a flight to cash by firms, households and banks? Would asset prices and exchange rates respond in desired ways? Would policy rates be transmitted to bank loans and deposits? Or could negative rates lead to a sharp fall in bank profitability, harming instead of boosting credit, and even potentially lead to financial stability risks and market disruptions? So these are the questions that we look at in this stock-taking paper. So let me start with the first point about cash hoarding, switch to cash. So bottom line is that this has not happened, so far at least. The interest rate below which there would be a move away from other deposits and bonds into cash is called the effective lower bound, ELB. And it is mainly determined by the cost of storing and holding physical cash. And again, so far there is no evidence of a widespread increase in the use of cash. Even though in some countries the use of cash has grown over the past 2 decades, as you can see in some of the charts in the paper, there is no indication that these increases were accentuated by the introduction of negative rate policies. And similar trends can be found in countries that have not adopted them. And when it comes to cash involved, cash held by banks, the introduction of negative rates has not been followed by an increase in cash involved, except for the euro area, where we have seen some increase in cash involved. Now, let me turn now to the transmission to asset prices. And here we have seen a strong transmission to asset prices as policy rates went negative. And the impact has been most visible in short-term money market rates. Yield curves shifted downwards after negative rate announcements, showing an immediate and persistent negative response, as we can see here in the case of Sweden. Once rates were negative, the impact of interest rate cuts on the yield curve appears to have been similar to that of interest rate cuts in positive territory. Stock market indices kept rising after central banks moved official rates into negative territory. The evidence on corporate bonds is more mixed. And in the case of Denmark and Sweden, the evidence suggests that negative rates contributed to easing appreciation pressures. How about bank rates? Overall, the evidence also suggests that there has been transmission to bank rates. Negative rate policies lowered rates on new mortgages and corporate loans, especially floating rate loans that are indexed to money market rate. However, there is quite a bit of heterogeneity across banks and the effects on lending rates as well. Deposit rates also declined. However, for household accounts, mostly, but not or everywhere, the zero appears to be the lower bound. There is some evidence, for example, in Denmark, that banks have also started to charge negative rates on retail deposits. Typically, however, banks started to increased fees on accounts for households. We looked for structural breaks in the transmission of policies to see if there was something different once you cross the zero bound. But we did not find that the association between policy rates and bank deposit or lending rates had changed after the adoption of negative rates in any of the countries surveyed here, except maybe Denmark. As mentioned, a key question is how negative rates affect banks. And the channels are multiple. This chart gives a summary of the channels by which they can affect bank profitability. If bank reserves pay a negative in nominal interest rates, then bank income will decline if they cannot pass on the cost fully to deposit. So that will reduce net interest rate margins. To the extent that negative rates contribute to a steepening of the yield curve, it may actually have a positive effect on net interest margins. Banks will also earn less on the liquid assets, such as reserves and short-term paper. On the other hand, negative rates may support banks' net worth by boosting asset values. And importantly, if negative rates succeed in boosting activity, it will improve loan quality and reduce the need for provisions. Now, when banks' worth is harmed overall by negative rates, then cuts in rates could in principle produce less, not more lending. And the value of the policy rate when the adverse effects on bank lending outweigh the positive effects is called the reversal rates, term coined by Markus Brunnermeier and his co-author Kobe. This is distinct from the effective lower bound. But overall, the net effect of negative rates on bank profits and lending is mostly an empirical question which I will now discuss. Now, the evidence we surveyed covering the academic literature suggests that bank profits have broadly been resilient. Banks increased lending in part because lower rates have meant higher demand for loans by firms and households. This lending growth, gains in fees and other non-interest income, lower loan loss provisions, and the realization of capital gains have all helped. Nevertheless, smaller and more specialized banks appear to have been adversely affected. There is also some evidence that banks' stock prices have suffered, especially for banks that rely more on deposit funding. This finding potentially suggests that markets either expect that negative rates will harm bank profitability in the future, or that they don't fully capture the the actual effects. Given the evidence, it's likely that tiering regimes, that is, regimes by which interest rates only become negative when a bank holds large amounts of reserve balances, can help mitigate the potential adverse effects on small banks. Now, ultimately, we are interested in the effects on inflation and output. Now, the evidence on inflation and output directly is scarce, since the policy is relatively new and we need to accumulate more data to assess this. And this is particularly difficult because of the identification problem, right? It's difficult to isolate the effects of negative rates because they have almost always been introduced alongside other unconventional monetary policies. So that's difficult to do with macro data. Still, judging by the effects on long-term rates, we could expect the effects on inflation and output to have been at least as large as those estimated for conventional monetary policy. And this view is supported by model-based analysis. Now, negative interest rate policies do pose communication challenges. And central banks have followed different approaches in discussing negative rates. Still, we can distill some lessons for central banks. First, we believe that central banks should clearly explain the expected benefits of adopting these types of policies and the likelihood and size of potential side effects of negative rates. Second, central banks need to stress that they will continuously monitor these potential side effects and act to alleviate them with adequate instruments. Third, communication should highlight the difference between nominal and real interest rates, emphasizing the prominence of real rates in affecting macroeconomic conditions. After all, in a way, real rates have been, negative real rates are nothing new. We have seen them a lot in the past. And maybe most importantly, we believe that central banks that have not adopted negative rates should not completely rule it out, because such ambiguity may support forward guidance. Because if people below that believe that there is a floor at zero, that will naturally constrain the range of future expected interest rates. So let me conclude. Overall, the effects of negative rates have so far seemed benign. There was effective transmission to asset prices and interest rates, and probably most likely to inflation and output. Overall, the net benefits of negative rates likely depend to some extent on the structure of financial systems. So you cannot expect the same effects across countries. There may exist some room for central banks to cut rates further, even there is considerable uncertainty about how negative rates can become before significant adverse effects become apparent. But let me also highlight some areas where we need to gain a better understanding, where we need more research. For example, the literature so far has largely overlooked the impact of negative rates on financial intermediaries other than banks, and that is quite important. Overall, the competition in the financial system and how it shapes transmission is not well understood either. And lastly, the cross-border implications also need to be better explored. Thank you.
Well, thank you, Gaston. That was very clear and comprehensive and good timing. So let's go straight to Silvana Tenrero for her comments and views. You have also given speeches on this topic. You also have some slides, so let's wait until you share your screen. And I'll hand over to you directly.
Thank you, Volker. Good afternoon, everyone. And thank you very much to the organizers, the IMF and the IMFS, for inviting me and for putting together this panel. This chart shows that policy rates are now negative or close to zero in many advanced economies. It means it has been vital for monetary policy makers to be thinking urgently about the merits of different policy options, and especially for those who have implemented negative rates to assess their impact so far. Given that, I'd like to commend Gaston and his co-authors for such an authoritative report and the great effort in putting together the evidence to come up with a clear set of conclusions on the experiences and evidence that we have accumulated so far. Now, as Volker said, I set out my own take on some of this evidence in a speech back in January, and I find myself in broad agreement with the findings Gaston has just discussed. In my opening remarks, I like to draw out and expand on some of the points in the report. I'll focus mostly on the evidence from other countries' experience and the literature, but first I wanted to touch on communication. Communication with the public is important with any new policy in order to ensure public understanding and trust, essential for independent central banks. I think that the report makes some excellent points on this. To draw out three here. First, it highlights that there are some factors that may make negative rates less challenging to explain than some other policies, such as quantitative easing. The transmission mechanism is almost identical to that at positive interest rates, so it should already be relatively better understood. Indeed, in the UK, a recent study of public understanding by researchers at the Economic Statistics Centers of Excellence found that the public are more familiar with the concept of interest rates than other economic concepts. Second, the report stresses that we should make clear that negative rates should not be viewed as extraordinary. I would extend the point to include low positive interest rates in general. For some who remember the very high interest rates experienced in the not too distant past, those high interest rates may be perceived to be some sort of normal level to which rates should return back. But this chart shows a very long historical time series, 150 years of UK policy rates in orange here, and deposit rates in blue. And it makes clear that rates have been at low levels in many periods during the past. And if anything, the high interest rates in the 70s and 80s, before the UK adopted inflation targeting, were the exception rather than the rule. And third, the report highlights that we should communicate the crucial distinction between nominal and real interest rates. If I build on the equivalent real interest rates on this chart, by adjusting for realized inflation, you can see that real interest rates have been negative many times before. Communication is important to explain why negative rates are added to the toolkit and explain the policy, should they need to be used. But to decide whether they should be used depends both on the economic outlook at the time and on the judgment about whether they or some other tool would be more effective. I would therefore like to emphasize the key points I take from the evidence on the effectiveness on negative rates so far, which I think are broadly in line with the findings Gaston has presented. First, and perhaps most important to stress, is what I've described as the financial market channels of monetary policy transmission. They have worked effectively under negative rates. By that, I'm referring to channels that operate outside the banking sector. Transmission via standard cost of capital and exchange rate mechanisms, as well as higher asset prices, has been similar to what we see at positive interest rates. And in just that same way, these effects should lead to higher consumption and investment and boost net exports and inflation when compared to a counterfactual with higher rates. Crucially, these financial market channels are a quantitatively important part of the transmission mechanism. Now, it is difficult empirical exercise to try to split out different channels, But UK estimates from the Bank of England's suite of models suggest that financial market channels operating via the exchange rates, firms' cost of capital, and households' financial wealth account for 1/3 to 2/3 of the total medium-term impact on output from bank rate changes, and 1/2 to 3/4 of the transmission from bank rates to inflation. The exact split will vary across countries, as I'll come on to discuss, and may also vary over time. If market-based finance continues to grow in importance, for example, then the impact of these channels may even increase. Second, I agree that the evidence from experiences of negative rates in other countries suggests that bank lending channels of monetary policy transmission have also been effective at boosting lending and activity. There is variation in the size of the estimated effects, but I agree with the report that any hint of a reversal rate coming from any counterproductive effects on bank credit supply is currently a theoretical concept, not backed up by the empirical evidence we've seen. I also think that there are sound theoretical reasons to doubt we will see counterproductive effects. Given the presence of significant amounts of non-deposit funding, bank funding costs should fall even if household deposit rates are constrained. This creates space for banks to both reduce loan rates somewhat while still preserving their margins. I find it unlikely that we would see any combination where banks would simultaneously reduce their loan rates substantially, such that their profits fell materially, while also reducing the supply of credit. That brings me to my third point on the evidence, which is that empirically there is no clear evidence that negative rates have reduced bank profits overall. Some studies do find that banks' net interest margins tend to fall when policy rates go negative, although this is also the case for some studies of rate cuts at positive territory, particularly at low levels. And there's a paper by Clayson, Coleman, and Donnelly making this point and showing the evidence on this. At any rate, net interest income is just one component of profitability, albeit a very important one. It is also important to take into account the general equilibrium effects of a stronger economy on lower loan losses. Once they do so, a number of studies find neutral or even positive impacts of negative rates on overall bank profitability. In all, I think the evidence we obtained from international experiences indicates negative interest rates have imparted stimulus in much the same way as rate cuts at positive interest rates. Of course, there are always state contingencies in the effect of policies across time and potentially across countries. And I highlight a few on this slide. For bank lending, as the report stresses, in banking systems where deposits make up a larger share of funding or where deposit rates are currently close to zero, we might expect that banks will have to curtail pass-through by more, all else equal. Although banks may have other strategies open to them to mitigate these impacts, such as increasing fees or shifting the mix or the maturity of their liabilities. On the asset side, a greater quantity of debt or a larger share of floating or short maturity debt might suggest stronger cash flow channels of monetary policy on the economy. And in financial markets, one would expect the exchange rate effects of monetary policy to be stronger in small open economies than larger, more closed ones. While, as I mentioned earlier, cost of capital channels operating through bond markets may be higher when there is a greater degree of market-based finance. For the UK in particular, some of these differences go in either direction. My overall assessment is that in line with this report, if needed in future, negative interest rates should boost growth and inflation. Financial market channels would be likely to operate as normal, and bank lending channels at worst, are only likely to be somewhat less powerful than normal. And let me show you my last slide summarizing my key points. Financial market channels of monetary policy have worked effectively under negative rates in other countries, if not more powerfully. Bank lending channels have also been effective with some variation in the estimates. There's no clear evidence that bank profits were reduced. And finally, differences in economic structure can affect how the tool works. The UK banking system could lead to a less positive impact on bank lending, but on the other hand, financial channels should work normally. I'll conclude here. Thank you.
Well, thank you very much, Silvana Tinvero, for this very clear position and points. I've learned summarizing in 3 points is ideal. So thank you for giving this clear direction from your perspective as a member of a multi-policy committee, the multi-policy committee in the UK. So let me hand over straight to Jörg Krämer. Jörg, I can't see you right now. Maybe we lost the connection, or is it just me?
We cannot see him.
Okay, so it's not just me. I hope he comes back. Let me quickly call him. In the meantime, you know, we can always take a question. I have some. Okay, well, I can't reach him right now. So let's hope he's going to come back on. And maybe let's ask in the meantime, Gaston, do you want to react briefly in any way? I mean, it was very supportive of your analysis, but nevertheless.
No, I think it was complementary, and I didn't have time to discuss everything that we do in the paper, and Silvana highlighted some things that we touch upon and some others. So I thought it was quite complementary in terms of adding to the points that I made.
Very good. So, okay, I'll postpone my question because Jörg Krämer is just back on. Mr. Krämer, you want to take over? Do you also have some slides you want to share, or go straight to presentation? I think you have some slides also.
Yeah, I would like to join with the slides. Wait a minute. Bildschirm freigeben. Was denn? Hier? Geht drauf, das? Teilen. Oh. Yeah. Mr. Wieland, is everything okay with the slides?
Yeah, I mean, it's still in, you have to put it in presentation mode, but this is fine too. I mean, if you can do it in presentation mode, that's great. But let's see how it goes.
It's now in presentation mode? Mr. Wieland, in presentation mode?
Not yet.
Not yet. Wait a minute. Yeah. Es geht nicht. Not yet in presentation. Wait a minute.
Das ist auch umgeschaltet. Das ist auf einmal Transfer. Fangen wir mal an einfach.
Mr. Wieland, may I start?
Yeah, it's fine this way too. We can see the slides.
Okay. Okay, first of all, thank you very much, Mr. Wieland, for the invitation. Thank you to the IMF for the invitation. And before I start with the details, I would like to deliver my main thesis. And first of all, I would like to say that I question the logic behind the negative interest rate policy, insofar as there are a lot of question marks behind the estimates of the equilibrium real interest rates. And secondly, I would like to show that the negative interest rate policy did not lower inflation much. The third point is that the negative side effects of the negative interest rate policy are to rise over time. My last point is a political point, that it is very difficult to exit negative interest rate policy. Well, let's start with the first point regarding the equilibrium real interest rate R star. Let's suppose R star, let's say, is minus 1%. And if then the nominal policy rate is cannot fall below 0 and is exactly at 0, and if inflation expectations are only, let's say, 0.5%, then the real interest rate cannot fall below minus 0.5%. That means in such a situation, the central bank would not be able to lower the real policy rate below R star, and they would not be able to stimulate the economy. And in order to bring the real interest rate below R star, the nominal policy rate obviously has to fall below the 0 line. And insofar, a low R star is a precondition to justify the negative interest rate policy. However, let's look at the evidence. And here I have referred to a paper in the Bank of International Settlement Annual Report 2018, and it shows you estimates of the equilibrium real interest rates on the left side for the
Mr. Kramer, just to interrupt, sorry, the slides are not moving for some reason. So maybe you can, it worked fine before when we tested it. So I can see on the left hand, you know, that the slide 2 has the picture you're referring to.
Yeah, exactly.
But it's not being shown as the main slide, you know, it's not being presented.
Okay, we try it again.
Maybe you want to redo the slide sharing.
Machen Sie mal klein.
Den anderen Hintergrund, das wir machen anders.
Yeah, okay, now we can see it.
Ja, genau, wir können jetzt nicht jetzt mal durchziehen. Das ist verbinden. Lassen Sie so, machen Sie zu. So, jetzt können wir das Ganze sehen und wir können es ein bisschen schöner einstellen.
Yeah, now we can see it.
Yeah?
Yes, it's good.
Okay. Sorry. Good. Okay, good. Thank you. Okay, all these technical issues. Okay, you have estimates for R star on the left-hand side for the US, on the right-hand side for the euro area, and you have estimates from various authors. And I would like to draw your attention on the standard error band, which is ±1 standard error around the estimates of Holston et al. And have a look how wide this band is. Yeah, in the United States, it goes from -1 to more than 1%. In the Eurozone, it goes from -4 to +4. That means this is obviously a huge uncertainty as far as the estimates is concerned. And I hesitate to base things like negative interest rate policy on such a weak empirical and uncertain method. And now I go to the next chart. Volker, can you see this?
Yes.
Good. And I think it's not a wonder that the estimates are so unreliable, because you can also question the assumption behind the models. Look at the Laubach-Williams model for estimation of R star, for example. It will rest on questionable assumption. For example, if the inflation rate is below the target of the central bank, then Laubach-Williamson would say, well, this is caused by a weak economy. But is the Phillips curve still valid when you take into account globalization, digitalization, etc., etc.? And secondly, is a weak economy always caused by restrictive monetary policy? Of course not. Economy can also be weak by non-monetary factors, for example, after the burst of a bubble. Or take the estimates of Rachel Smith. They base their estimates on saving investment imbalances. Yeah? But R star is not only influenced by savings and investments. It is also influenced by bond purchases of the central bank. And the next point is, and the estimates of the structural drivers such as demography on the savings and the investment curves are highly uncertain. And the estimates of the impact of the slope of the curve for savings and investment also extremely uncertain. With this calibration model, you can produce a lot of results. That means, to sum up, I doubt whether we know enough about R star to justify negative interest rate policy. Turning to my second point, and this is the impact. This is the impact on negative interest rate policy on inflation. And Gaston, you referred to this study, which you can just see here. This is from a working paper from the ECB, December 2019. Mr. Rostanio was one of the co-authors. And this is from this paper. And it refers to the year 2014 to 2018. And the solid line is the inflation rate in the Eurozone. And the dotted line is a kind of counterfactual simulation which shows inflation without the expansionary monetary policy. And what they had there is the impact of TLTRO, FG is forward guidance, APP is the bond purchases, and NIRP is the negative interest rate policy. Negative interest rate policy is the contribution to the decline or to the increase in the inflation rate is here in green. This is not even 1/10 of a percentage point. How can you justify negative interest rate policy with this huge negative side effects when it raises inflation not even by 1/10 of a percentage point? Let's turn to the next question. And the next point I do have is that kind of dynamic question. That means the main effects of negative interest rate policy are likely to decline over time, while the negative side effects are likely to become more prominent. Regarding the main effect, consumers, or the logic, how does monetary policy, how does it work in a new Keynesian model? The logic is always the same. Consumers should bring forward consumption, and which should have an expansionary impact on the GDP in the current period. But these standard models do not assume that interest rates will be low, let's say, for many, many years, because consumers can't bring consumption forward forever. That means the expansionary impact of the negative interest rate policy is to decline over time. Turning to the negative side effects, they are likely to grow over time. I'm not only talking about the decline in the profitability of banks, but think of the governments. The governments get used to borrow at non-positive interest rates. And look to Italy, what this means. It's not only theory. Why should the politicians in Italy implement the necessary tough reforms when they know that they will continue to borrow with very low rates for very, very long? And my personal view is that Draghi will not succeed, or Draghi will succeed to organize more money from the European Recovery Fund, fine, but I think he is unlikely to succeed to implement the tough reforms. And this has nothing to do with Mr. Draghi himself. This has to do with political parties which do not have incentives to implement the necessary reforms if they know they can rely on extremely low bond yields, which are artificially lowered by the ECB with the help, among others, by the negative interest rate policy. Another point is zombification when we talk about negative side effects. Zombification, I think, is an issue. And here I refer to the Bank for International Settlement working paper from September 2020. And it shows you the share of firms which are classified as zombies for 14 advanced economies. And the authors define a firm as a zombie firm if the interest rate cover ratio is less than 1 and the Tobin's Q is below the medium firm in the sector, and all this over 2 consecutive years. And when you look at the blue line, you can see somewhere in the 80s, the share of zombie firms, according to this definition, was roughly 4%, of all firms covered in the 14 advanced economies, and it has gone up to 16%, and there's a lot of other evidence on this, and this has something to do with the artificially low interest rates to which NIRP contributes. Well, and then of course there is a problem with bubbles in the financial markets. You know, I know institutional investors very well, and I know how they suffer because they do not find enough bonds and other assets with rates with yields which are high enough, and therefore they feel a lot of pressure. They're more or less forced to go into more risky assets when you think of corporate bonds or even high yield bonds, or they are forced to accept very high valuations. And you look at the PE ratio, the price earnings ratio for the Euro Stoxx 50 starting in 2004, you know, currently it stands at 18%. This is extremely high. I'm not saying this is only caused by negative interest rate policy, but I think the expansionary monetary policy plays a huge role, because investors, they have to, there's a hunt for yield, they have to produce, they have to show earnings, and therefore there's a tendency for them to go into assets such as equity or real estate. And the risk is, it's not my forecast, but we may end up in a new bubble, and I don't have to tell you what happens if a bubble bursts. Well, I don't want to be over pessimistic here, but for obvious reasons, I concentrated more on the problematic side of negative interest rate policy because I would like to stimulate the debate, and I would like to thank you for your attention. Thank you.
Excellent, Mr. Kremer. Thank you very much for two reasons. I mean, three reasons, very clear. Secondly, as you said, this helps stimulate the discussion, but also it helps bring forward some of the issues that need to be tackled in central bank communication if central banks go into negative interest territory. Maybe, do you want to stop the screen sharing?
Yes.
For the moment.
Stop.
And at the same time, I asked Gaston if he wants to have an immediate, quick reaction, very brief. Are there any of the points you want to very briefly react? We have already a lot of questions.
Yeah, so let me be brief. I think we're going to could talk a lot about all of these points, and thank you very much for bringing them up. On the estimates of R star, yes, they have mostly have large confidence bands. I would like to highlight that the IMF's estimate for the natural rate in the euro area is actually negative and has a relatively small confidence band. But be that as it may, the point, I mean, I would highlight, to me, what's striking is that they all point very much in the same direction, and you know, they are all in a way remarkably similar, and I think that's what I would highlight. And you are arguing that the uncertainty about the precise estimates, the point estimates, means that you should be less aggressive. I think the dangers of overestimating R star and not acting are much bigger. Then you mentioned the role of the importance of negative rates in the quantitative importance in bringing inflation down relative to the counterfactual. I mean, it's about 20% of all the unconventional monetary policies, which is not minor. There are and you mentioned that, you know, it's the cost-benefit relation, right? Well, our paper makes the point. We were interested in the question: are the side effects so big? And our assessment is, well, they are not there yet. So, but I agree that they over time they may actually accentuate. So we make that point in the paper. We acknowledge that that this could happen. over time. So we need to be watchful. Zombification, yeah, but that's not unique to negative interest rates. There we need clear supervision and regulation and transparent balance sheets. Search for yield, a bubble, search for yield is something we have been warning a lot, quite a bit. We have been pointing out the dangers that the low interest rate environment brings about. We have not seen, some kind of non-linearity that happens with negative rate. So I'm not saying that there are no financial stability risks associated with low rates. There are, and we need to take action. We need to have the right macroprudential tools for that. But what we have found is that there are no clear, discontinuity, no change in terms of the degree of financial stability concerns once you enter negative rate. And stretched asset valuations, yes, again, that's a low interest rates phenomenon. We have also said that in many markets, these valuations seem stretched. But again, that's not particular to negative rates. Let me stop here and not monopolize.
Thank you. Yeah, we can also at the end have a quick round too. But let me ask nevertheless, Silvana Tenrero, if you wanted to throw in a quick sentence on anything.
Well, Gaston covered most of the points. So, but let me reiterate, I guess, two things. One is that optimal monetary policy should be counter-cyclical. It is there to offset the forces that weaken the economy. So, yes, we agree with you, Jörg, that there are many forces that are weakening the economy, and what monetary policy tries to do is to offset those. But how? By boosting lending, and through lending, that's one of the challenges, of course, and then by lowering the cost of capital, moving the exchange rate, and boosting asset prices. Those are the mechanisms through which monetary policy tries to offset the weakness that can be due to many other factors, of course. On zombification, I mean, conceptually, a zombie firm is a firm that is using resources that would be better employed by other firms. And in a context with high unemployment, which is what you're trying to offset in some sense with your monetary policy, they're not really detracting resources from other firms, productive firms. I mean, there are more structural problems with productivity, and a reason why we should work on enhancing productivity. But again, you enter into definition territory. What's a zombie? Would you rather close all these firms and generate high unemployment, and all these low-skilled workers or low productivity workers will be out of work? Would that be a better situation than a situation in which you keep low productivity firms that are not really detracting resources from others? And I'll stop there. I'm happy to engage with other questions.
Mr. Kremer, just to be fair, do you want to have a response to the responses very, very briefly so we can go to the questions, or should we go towards the end? Either way.
Well, I would like, as far as the impact of the negative interest rate policy on inflation is concerned, yes, Gaston was right that in the study of the ECB, negative interest rate policy stands for 20% of the overall impact. But 20% of the overall impact of 0.4 percentage points, is not even a tenth of a percentage point as far as negative interest rate policy is concerned. That means the 20% does not say much when it's not even 0.1 percentage point. Then I have a remark regarding a chart from Silvana. I have to say I love these charts with a very long history, starting in the 18th century, for example. And in the UK, of course, you have the privilege to have these long-run data. But your chart, where you suggested that that low yields or even negative yields is nothing so uncommon in economic history, we have to see. I have to say that your chart had a very flat format. Insofar, we have to say that during the gold standard, for example, the interest rates have always been positive. And where we had been very low yields, this was primarily in the 30s, where we had a depression. and a situation which can't be compared to the situation today. I think one has to put this into perspective.
Okay, let's, if needed, have another round at the end, but let's take some of the questions. We actually 25 questions here. Now let me go to the top. I think there were some questions which are sticking to the top, which are a little more directly related, given that Silvana Tenrero is a member of the Monetary Policy Committee. So basically, people are asking, this morning it was reported that Andy Haldane saw a sharper and more sustained rise in inflation. For me, risk is policymakers have to react more aggressively than is currently priced in by financial markets. As greater risk is central bank complacency, allowing the inflationary cat out of the bag. And does this rule out negative rates in the UK for the foreseeable future? There are two questions. I don't know if you want to address that. It's not directly related to our topic, but to some extent, it's up to you.
So the forecast of the Monetary Policy Committee, the central projection has inflation returning to target from below. As you know, inflation rate, the last recording was 0.7% in January. So we are undershooting our target. And in our central projections, you see a trajectory through which inflation catches up with the target from below. So we get to our 2% target, but there is a slight overshoot in year 2, and then we go back to 2% in year 3, and the overshoot is literally in 10 basis points. So I don't see any risks on inflation there. Thank you.
Thank you. Here's a question for all of you. How do you foresee an exit from negative interest rate policy? What circumstances would be required for that to happen? And how can central banks manage the likely fallout in terms of asset prices, housing, equities, fixed income? That certainly concerns in particular, I guess, the euro area. Yeah. But all of you, any responses?
May I respond to this, because this was exactly my last slide, which I forget to talk about. And indeed, I think there are a lot of risks, because before you raise interest rates, you have to put an end to QE, and this by itself is already something which will be very difficult for the market to digest, and therefore. Coming to an end with negative interest rates is something which will be very, very difficult for the ECB. There will be resistance by the politicians of the highly indebted countries who currently benefit from this policy. There is a risk that you trigger bankruptcies. There is a risk that the high valuation may burst. Perhaps we then have a bubble. At least there are a lot of risks, and therefore I think that the ECB is fully aware of these risks, and it will be very, very hesitant to exit the expansionary monetary policy. I think the really difficult moment will come when, I don't know when, in 4 or 5 years' time, the inflation rate in the Eurozone really goes up and goes beyond 2%, 3 or 4, whatever. And in such a situation, there will be very, very ugly decisions need to be made by the ECB. And I think I would not assume that the ECB will then exit the monetary policy in a perfect way, which is why I expect the inflation rate in 5, 6, 7 years down the road to be significantly above 2%. And I think we are running in the long term, in the long run, in a kind of inflation problem. I'm not saying that we're returning to the 70s. That would be far too aggressive. But I think there will not be a smooth exit.
Maybe let me add on this question and pose it to Silvana and Gaston. Could it be that, given that we have a mix of measures, quantitative easing and so on, could it be that by relying more on negative rates on the short end, but less on other measures, maybe it could help us get out of that, of the problems which Mr. Kramer mentioned more easily. I don't know. Silvana, do you want to say something to that?
So I'm less clear on what problems he's suggesting. If the economy recovers and inflation starts picking up and getting close to target, obviously monetary policy will react to those to that, and as it's always has done in the past. So I can't see the difficulty. I mean, if I think in some sense it's easier to tighten than to loosen. That's the situation we are in with a very low neutral real interest rate. So I don't see the difficulty in tightening. If anything, we've been talking about an asymmetry for loosening, and that's the zero lower bound, and what we're discussing here, that zero lower bound may have been an exaggerated fear. But I don't see any problems in complying with the targets and achieving the inflation targets by central banks. They have the tools to get there. The problem is the opposite. The big risk we've been facing is that if the economy underperforms even more, then there would not be enough ammunition to fight off that weakness. The other problem is a lot easier to address for central banks. And just a correction on what Mr. Kramer said before, because he was referring to to low real rates in the 30s. The chart I showed the low rates in the 20s, the 40s, and the 70s, real rates. So it's just for the sake of clarity. Thanks.
Yeah, for the US, rates were very low in the 30s, for example, near zero.
Yeah, I was showing real rates for the UK.
Yeah, I know.
And as I show also, nominal rates were low through a much longer period. But I think he was referring to the real rates and the big spikes in my graph. Thanks.
Yeah. And Gaston, anything on these risks and what role negative rates could play relative to other tools?
Well, I would agree with Silvana that it would be good news if inflation expectation and inflation developments rose, and that would allow for monetary policy to become more normal, right? The struggle, as I was outlining in the beginning, is precisely that it's very difficult for central banks to operate at these low levels of negative rates. So I don't foresee a fundamental problem there. We have also very independent central banks, and the ECB is extremely independent by construction. As for the, how exactly to proceed in that scenario, I don't want to speculate. That will depend a lot on circumstances. I mean, as you know, when the Fed started slowly to normalize, the idea was to first pause purchases and then, to raise rates so as to gain a bit more policy space with the instrument that whose effects you understand best in a way, the more traditional instrument. But it will depend on the situation.
Okay, there's another question for Gaston, which got a lot of votes by Alexandre Chailloux. Mr. Kramer will come back and then maybe we can take it together. This fits in quite well. Question for Gaston: rush to cash did not happen, but how about rush to other alternative, perhaps more risky, like crypto assets, tokens, etc.? Some countries show a continuing secular decline in currency and circulation, the Nordics. Could it be another side effect of negative interest rates?
Well, I haven't looked at this closely, but I don't think that the shift or the investment in cryptocurrencies has been less in countries that have not adopted negative rates, in the US, for example. And furthermore, I would say that these cryptocurrencies are completely different assets from household deposits. These are vehicles that exhibit a lot of volatility, And I think the question of why we're seeing a lot of interest in them is has to do with we have to. It's a debate about how bubbles may create and expand, and so I don't think it has specifically to do with a negative rate. I'm not ruling out that some of it may have to do with a low interest environment, with people searching for assets that may promise some higher return. And as I said earlier, we are concerned about some aspects of search for yield around the world. Thank you.
Thank you. There's another question. Will the slides be available after the presentation, please? This is to me, so I would say yes. We will send around an email to all registered participants after the session with links as soon as we have uploaded the different presentations on the website. There will also be a recording of this talk, and so we'll send around links to that later. Let me go to the next question. Your panelists disagree on the effect of interest rates on the profitability of banks, from Stanley Colbert. Could we have some discussion of this disagreement? So that's to all three of you. Let me start with Mr. Kramer. So he is from the banks, and if he wants, he can respond to or react to any of the earlier points if necessary. Bank profitability. We can't hear you for some reason, even though the mic is not turned off. I don't know what's. Can you hear me? Strange.
Can you hear me now?
Yes.
Okay. I think when you read analysts' report on banks, then it's clear that banks suffer from negative interest rate policy, which, by the way, was also the reason why the tiering systems were invented. But the Bundesbank showed in a report recently that despite the tiering system, the negative interest rate burden is still there. But I think the negative interest rate burden is not one thing. The most important burden from the negative interest rate policy on banks is that it contributes to a general decline in risk premium and in lending margins. And this, I think, is the most important contribution. And I think countries such as the US, when they decided not to go into negative interest rates, I think they also had this effects on banks in mind.
Silvana, you want to say something to that?
Yeah, I think some studies find that banks' net interest margins tend to fall when there's a policy rate cut. That happens both in negative and positive territory. Whenever there is a cut, there is a fall in NIMs. But what matters for profitability is not just NIMs, that's one part of the profits. It's also important to take into account the quality of loans, loan losses, and that has improved with the effect of negative rates, because it gives a boost to the economy and reduces the incidence of loans, so it reduces defaults. So once studies correct for these loan losses, they find that negative rates had a positive impact on overall bank profitability. Now, this is aggregate profits. Obviously, there is heterogeneity across banks, and maybe some suffered losses while others experienced the increase in profits. So this is an aggregate measure, and that's the one I was discussing. From a macroeconomic perspective, obviously we care about the health of the banking system as a whole, and the tiering system helps those banks that might have struggled without it with their profits, and there was obviously a rationale for that. But overall, the evidence suggests that there was no fall in profitability. If anything, it went the other way. Thanks.
Gaston, do you want to add something to that?
Oh, I mean, after an exhaustive, careful analysis of what the studies say, that look at different data, use different methodologies, and some are better than others, and really trying to tease out the effects, we come to the same conclusion. Yes, there are also some segments that maybe have been suffering, but overall, the profitability has not declined partly because of the macro effects that were just mentioned. And in principle, the argument is correct that banks, because they rely on maturity transformation, they're particularly hurt by a very flat yield curves. And in principle, some negative rates can help, as I said at the beginning, to steepen that curve a little bit. Now, one caveat is, well, maybe the adverse effects may accumulate over time. They may deepen. We haven't really seen them yet, but they may come. It's possible. But by now we've had, quite a few years of negative rate policies in the countries that have adopted them. So I find that a little difficult to believe. Thank you.
Thank you. In principle, we're at the end of our time. However, we still have about 240 participants and a number of questions. We won't be able to address all questions, but I wanted to ask you, the three of you, if you still have a few minutes, so maybe we can take 2 or 3 more questions.
Yes.
Okay. Okay, great. So let's try that. There are some questions. I'm going to try to summarize. There's some question on longer maturity government debt, on the effect of negative rates on the very long end of the yield curve, particularly in the UK, but other places. Is there reason to think that effect is different from when you lower rates in the positive range? There's also a question to Silvana, how low can the policy rate go in the UK? What's your estimate of the effective lower bound? What we always want to ask any member of a multi-policy committee. And what about digital currencies? Could they be used to lower the effective lower bound? Maybe to all of you, and whether the whether the negative rate has really changed household behavior. Silvana, do you want to start, since there was this direct question to you?
Okay, I'll start from the last one. Technology has already lowered the effective lower bound. I mean, we're all making most of our payments digitally these days. So the cost of having to switch to cash is quite high, actually. So these lower bounds are not set in stones. They are affected by technology. They can be affected also by policy. And in fact, the German economist Silvio Gesell many decades ago had proposed one of the first solutions of how to implement or lower or eliminate the lower bound by having stamped money. Anyway, so how low can it go? I mean, this is, again, heuristically, we've seen countries going as low as 75 basis points in negative without having any problems. So at least there you can go. But as I said, these lower bounds are in some sense policy choices and are affected by technology. And the more we switch to digital payments, the more they will be lower. I mean, one way of conceptually of thinking of interest rates, positive interest rates are like a tax on cash. Whereas negative rates are like subsidies to cash. They make cash more appealing, and so the idea is how to offset that subsidy so that people don't switch to cash. Now we haven't seen any of that switching in the experience as Gaston showed, but conceptually those are the issues, and the idea of Silvio Gesell, for example, was how to offset that subsidy by having stamp money. I'll leave it there.
Gaston?
Yeah, maybe on the question about the effects on long-term yields, what we have observed is that the first announcement of negative rates had a very strong impact on longer-term yields. And that's understandable, right? Because it implied a revision of expectations about what's possible in the future, to put it simply, right? That an expansion of the range of interest rates, removing the lower bound, and so that's what we have observed, and that's also one reason why we argue that central banks should not rule out using negative rates. On the effective lower bound, I think that's an open question as to how low rates can go. I think these estimates have been revised downward, but it remains an open question. Thank you.
In Jörg, Kremer?
Yeah, as far as digital central bank money is concerned, I think sooner or later it will replace cash, and then investors will no longer be able to avoid, to escape negative interest rates by switching to cash. And therefore, I think digital central bank money in the long run will put the central banks in a position to push through even more negative interest rates into the real economy.
Isn't that, just let me ask back, isn't that going to be a big problem for banks if people move their deposits in maybe central bank digital currency or digital accounts?
Sure, this is a kind of disintermediation problem, and central banks will probably solve the issue with a kind of penalty rate on digital money, or with caps. That means by this you can avoid, of course, this massive disintermediation with the negative impact on loans to the real economy. But the price you have to pay is that you put the central bank in a position to push through even more negative interest rates with all the related risks I discussed before.
Maybe let me have a last round with the three of you, just summarizing a few of the questions. That will be our last round, and then goodbye. We won't be able to touch all the questions, but maybe this is still possible. So Petro Polvora mentioned, what about the financial stability risks related to negative interest rate policy? So there's some people are asking questions about those. And he asks whether macroprudential policies are enough to tackle those financial stability risks. Then other people ask, such as Douglas Lexton, what about, given that the available measures have such a small effect or are not sufficient, do we need to think of a full policy package, all unconventional instruments plus fiscal, and whether that will get inflation expectations back to the target? And Thomas Pelkonen said, excellent panel, and asked about non-linearities of negative rates. Do we have evidence of non-linear effects or risks? That's the final round. Maybe let's start with Silvana and then Jörg, and then end with Gaston, who started this.
In financial stability risk, obviously, is something that central banks are constantly monitoring, so it's very important. Now, I think it's also important to understand where we are, why we are here with low interest rates. And again, there are structural factors that have put us here that had, and Gaston mentioned demographics, productivity, also uncertainty. The higher incidence of tail risk increases the demand for safe assets. So it's this increasing desire savings relative to investment that has pushed down on interest rates. So when you gauge financial stability risk, you should also consider that your rates relative to those low structural rates. We're there because people have saved a lot more relative to investment. So and that's the force that again you want you're acting on. So yes, it's very important is to constantly monitored, and there are many macroprudential policies in place to offset them. But again, it's important to think about low rates in relation to equilibrium rates. You can, I mean, otherwise, you know, what's the benchmark? Are you thinking about the rates from the 80s and 70s, unusually high, or, you know, it's you need a framework to think of what's low relative to what. And by the way, some of the reasons why we have lower interest rates right now are good ones. We can live longer lives. Life expectancy has gone up. Women are having fewer children. They have a choice, and so on. So not all is gloomy. Thanks.
Thank you. So, Jörg Kremer?
Yeah, well, I think what I heard before, as far as monetary policy is concerned, as far as exit from the loose monetary policy is concerned, I think this was a bit politically naive or ahistoric. When you look at the 60s in the US, where the inflation problem started, and when you go there into the detail, then you will find out that the close cooperation between the Fed and the US finance minister, this was the main reason which undermined the de facto independence of the US central bank. And therefore, they were not able to prevent money supply to grow too strong. And all this de facto, or the missing de facto independence, you may also call this fiscal dominance, this plays a huge role, especially in the Eurozone, where the root causes of the sovereign debt crisis in many countries is not yet solved. Therefore, you can't easily say, you can't only say, well, the ECB is legally independent, and if the economy recovers and inflation goes up, like in a textbook, then they raise interest rates. I tell you what, this will not happen, because monetary policy, they have to look at the stability of the euro or the stability of the state finances in countries such as Italy is not endangered. And therefore, I have a clear forecast. Yes, central banks will act, the ECB will act, but I'm quite certain they will not react in a way which is necessary in the end to prevent the increase in inflation. I'm not talking about what's happening now, but I'm talking about what may happen in 5 years time down the road. And I also find, last word, a bit unrealistic to say that macroprudential policy can do the job. Macroprudential policymakers are not as independent as many people think. You have there not only independent central bankers, but also representatives from the political system. And they are not yet able to, are they really able or in a position to disturb a party which is currently in the financial markets? And do they always have the necessary tools? Long story short, I think I like macroprudential policy, but I think you overburden macroprudential policy if you say they should tackle alone the financial stability risk of this loose monetary policy.
So final remarks by Gaston.
Thank you very much. Various points. So on financial stability risks, we have been pointing repeatedly to financial stability risks that comes with the low interest environment. I would also like to stress along the line with Silvana Terrero that we should not think of these low interest rates as driven by the central banks. So low interest rates do pose some problems, and they're certainly there, and we need to do something about it. But what I would just, in finalizing this discussion, underscore is that this is not driven by the central banks. Central banks are reacting to it, and so macroprudential policies, I think they don't need to act only to end the party. No, they can also ex ante strengthen resilience. So they part of it is to build up, for example, buffers in good times, right? So the macroprudential tool set is not complete, it's not perfect, and so we need to keep working on that. But I think we have at least made quite a bit of progress since the global financial crisis. There are areas where we need to make more progress. That includes the non-bank financial sector. The questions of stimulus now versus higher risk later. That is also an issue for monetary policy, right? And we are working on these issues. Tobias Adrian at the IMF has written recently on this, that central bankers need to take into account the intertemporal trade-offs in their policies. But I think the first line of defense against this is macroprudential policies. Monetary policy, can it do all? No. And in fact, we, but not only we, many economists have been saying that fiscal policies and policies to boost productivity, reforms, they all need to help to raise R star, right? And I think that's something that comes more and more to the forefront. How do we design smart fiscal policies, smart tax policies that at the same time are not too risky, because they may still also entail risk, but that can help to boost R star. Yeah, I think on Joachim's skepticism about reacting to inflation, well, if the economy recovers and the European economies recover and inflation goes up, that's good news. That makes Europe more stable, right? In a way, it reduces fragilities. And so I don't see that then the problems will be exacerbated. Thank you.
Thank you, Gaston. I think there are still questions. We could still go on, but we always have to stop when it's still fascinating and good, and they're open questions, because it keeps people on their toes and they sign in next time. So I think we wrap up now. We're 17 minutes over time. That's like a century in digital meetings. I always look, we still have about 200 people, and I always look at the names, and many good friends, many people from other events. Great to have had you here. I've also got some messages here from Lars Svensson or from Mr. Stetter from the ECB. So lots of positive feedback. So thank you very much, Gaston, Silvana, Jörg. It's been a great discussion. We could discuss more, but we'll stop here anyway, and hopefully see you all at some other time. Thank you. I know we could go on, right? But we just do it, it keeps people on their toes. So thank you, welcome, and goodbye, and hopefully welcome next time.
Thank you.
Thank you very much.
Bye.
Bye.
Thanks very much.